Okay. So we are into this equity securities. So I'm speaking about equity share. Okay. So equity share or preference share, we already know what is the difference between equity share and preference share. So I need not explain those differences. So let's say how to find out the value of a preferred stock. The question is, how come we can find out the value of a preference share? So as I told you, if you want to find out the equity share value or preference share value, you can find out that with the help of present value of future cash flows. You can find out with the help of present value of future cash flows. What do you mean by this present value of future cash flows? So whenever you buy a stock, the future payments, what you are going to expect is the dividend payments, of course. So year one or year two or year three, till the time, let's say, see, there is no maturity period for any of the stocks. But preferred stock is kind of it has a feature of loan as well as equity. Why feature of loan? Because they get dividends at fixed rate, and loans also, the companies pay fixed rate of interest for whatever the loans they take, right? So certain features match, right? So stocks generally don't have maturity period. You can hold it for whatever time you want. Okay. Let's say you want to find out the preferred stock value as on today. Okay. Let's say the stock you want to hold for 5 years. Let's say, see, I am not putting a precondition. The question, sorry. The question doesn't have any precondition that you are going to hold the stock for some period of time. That means for X number of years, they're not mentioning it. Let's say you want to hold it. You bought a stock for 100 rupees. Let's say, and you are in the third year right now. Let's say you're in the third year and you're expecting the value of the stock to go up till 150 rupees. Let's say that is going to be the stock value at the end of third year, and the return what you're expecting from this particular preference share is, as you have done some research and some calculations and some average you have computed, you think that 10% is what you're expecting. So how will you find out the share value? The share value will be, let's say you're getting dividend of 10 rupees every year. So 10 divided by 1 plus 0.10 whole power 1 first year, plus 10 divided by 1 plus 0.10 whole power 2, plus 10 divided by 1 plus 0.10 whole power 3, plus the fourth the third year you are also going to expect the stock value to go up to 150. So plus 150. So the first year, second year, third year cash flow is going to be 160, not 10. Please remember, first year cash flow in form of dividend what you are receiving is 10. Second year cash flow in form of dividend what you are receiving is 10. Third year cash flow you are also receiving dividend, and the stock value at the end of the year what you have found out is 150. Okay, so this is what is the way people calculate the intrinsic value of a stock or expected value of a stock, and based upon that they make their strategies with respect to a stock. Okay, so now we can do the calculation. So 10 into 0.9090, 10 into 0.87, just do the calculation. We'll do it. I'll find out the factors. 8264, 10 into 0.7513. Okay. So 9.09. Sorry, third year is 160. It's going to be 120.20. So 9 is 9.09. So plus second year is 8.264. Third year is 120.208. So we'll add up all of them. So it's like 137.562. So this is the present value of stock. So 138, let's say it should be. That means the stock which you bought for 100 rupees. Okay. You bought for some 100 rupees. Okay. That means you want to invest some amount on a particular stock. Okay. And it is giving dividends of this, and you are expecting the value to go till 160. So if this is the case and your expectation of the expectation from the stock is 10% returns what you want, so it will be 138. The intrinsic value will be 138 as on today. Okay, actually it should be 138. So if it is like 138, then that's good. If it is 140, then you can buy the stock for 138 and sell it for 140. Okay, you can wait for it to reach 140 and you can make good profits. If it is 120, that means it is trading below the expected price. Okay, you can do short selling. You can borrow the stock from broker or anyone who has this particular company stock. Let's say the company stock is SBI. The company's name is SBI. So SBI stock you can borrow from your friend. You can sell it today. You can get 138 in your hands. And then what you can do, you know that the stock value is going to is the stock is trading at 120. Actually, your expectation is 138. It's trading at 130. So just a second, just a second, just a second. If it is 138 and okay, there's a small mistake. Just a second. See, 138 is the stock, right? As per your expectation. In market, it is trading at 145. Let's say how much? 145. You can do short selling. What is short selling? Short selling is because the stock is trading at a higher value. You can borrow stocks from broker or from your friends or whoever holds it. You can immediately sell this stock and you can get 145. You know, like definitely the market is going to get corrected, or correction is going to happen because the stock is overvalued right now. Overvalued is actually its value should be 138, but it is trading at 145. It's overvalued. When it's overvalued, you can do short selling. You can sell at 145. Okay, you get 145 cash. And you know, definitely the stock is going to come to 138 at any cost because market forces are going to do that correction. Okay, because when people start selling the stock by borrowing, definitely its demand will come down and its value will go down, and one day it will reach 138, let's say in 10 days or something. Then what you can do, you can buy the same stock from market at 138. Okay, and then you can give this stock to your friend or to the broker from whom you have borrowed. You can return the stock back. That is the short selling, and in this you make a profit of 7 rupees, right? But let's say the stock is 120 today. Okay, actually the value should be 138, but it is 120. It's undervalued. You can buy the stock for 120. One day it will reach 138. Everyone knows, because when people start showing demand, they will buy a lot of stock. One day it will reach and come to 138. That's what I'm explaining you. Okay, but all this need not worry. Here it's very simple formula you have, but everyone should know the basic how the formula is used and what's the purpose of the formula. As I said you, the formula to find out stock value is present value of future cash flow. So the future cash flow is nothing but the dividend payment from the stock, which is D, and you're going to discount this. So if you want to find out the present value, you have to discount the future value. So if the future value is the dividend, let's say today you are buying a preferred stock, okay, and at the end of the year you're going to get a dividend of $10. Company is promising you a return of 10%. So let's say dividend is $10 and the return is 10%, 0.10. So the stock is of how much value? $100. That means you purchase the stock for $100. It is giving you a return of 10%, and at the end of the year you have $10 of dividend. Please tell me yes or no. Did you understand this? Hello. Yes. So now you can do the same calculation here. A company's $100 per preferred stock pays a $5 annual dividend. So the dividend payment for the stock is $5 and the required rate of return from the stock is 8%, 0.08. That means the stock value is 62.50. That means you bought the stock for 62.50. Okay, which is giving you the returns at the rate of 8%. And since it's giving you the returns at the rate of 8%, you are making how much? $5 at the end of the year, or you're going to get a dividend of $5 at the end of the year. You can do that calculation. 62.50 into 0.08 is going to be $5. That means if I buy a stock of 62.50 today, which is giving me returns of 8%, I will get $5 at the end of the year as a dividend. As simple as that. Okay. So here the dividend divided by the cost of capital or the cost of preferred stock will give me the preferred stock value. Please make do this. We'll go for the next question fast. If done, we'll move. Okay, let's go for the next one. See, the next Gordon's growth model valuation. This is Gordon's growth model valuation. I'll write the formula for you. So as per Gordon's growth approximation model or Gordon's growth model, you want to find out the value of a stock as on today. Okay. So you will take the next dividend. What is that? Next dividend, or it is also called as expected dividend. Expectation is of future. You should know that. So if the dividend, if at all they give you the present or current dividend, and you have to find out the expected dividend in the future, you can also do that. D1 in general means D naught into 1 plus G. That means the dividend as on today into the growth factor. Okay. Okay. Fine. So how I can prove that? Calculate the value of stock that is expected to pay $1.62 dividend next year. That is the next year dividend. As I said you here, next dividend or expected dividend. This 1.62 dividend, what you are going to get next year, is not having the actual value today as 1.62. It is the future value, which is 1.62, right? Definitely some value today has grown and become 1.62 in the future as next dividend. So if someone asks you a question, find out the present value of that dividend. How will you do? Very simple. We will take the future dividend 1.62. We will D naught into 1 plus growth factor. The growth factor is 0.08. So 1.62 divided by 1.08 is going to give you the present dividend. So 1.62 divided by 1.08, 1.50. That means today the dividend is 1.50, which is going to become 1.62 after 1 year at the rate of 0.08%. So 1.50, which is D naught into 1 plus growth factor 0.08. Sorry, G, growth factor G, 1 plus 0.08 is going to give you 1.62. I am explaining all this because in exam you'll not get such direct questions. They'll twist and turn everything. Okay, so you should have knowledge that this is the next year dividend, and they ask you what is the present dividend. Then you can find out in this way. So in this question, you are lucky that you haven't given they haven't given any extraordinary information. They just gave you the next dividend value, which is 1.62. So put it here, 1.62 D1 by KE, the cost of equity or the required rate of return from this particular equity investment, which is 12%, that is 0.12, minus the growth factor 0.08. Okay, so this is what, if you do, you are going to get the stock value, which is 40.50. Now what will happen? As the formula is very clear, you will be just noting down the formula, finding out the answer, and you'll not ask me any questions, sir, why did they subtract this growth factor in the denominator? and which is something which a student should ask. If you're not asking, it's my job or my responsibility to tell you. See what happens in numerator, D naught into 1 plus G. That means you are showing that your dividend is growing. Okay. And if in denominator, let's say here you are showing that your dividend is growing by how much percent? 0.08, right? But if you have to show that growth, or if that growth has to be reflected in the numerator, okay, that means you are showing that the dividend has grown from 1.50 to 1.62. If you take a discount factor of 12%, 0.12, what is going to happen? I'll show you. 1.62 by 0.12. (1.62) divided by 0 is going to be 113.5. That means when you are showing that your dividend has to grow, and if you are taking a higher discount factor, you are discounting very high value. The discounting will happen more. So that will eat away the growth what you are showing in the numerator, and the growth will not be reflected. So you need to adjust this denominator by subtracting the growth factor in the denominator and reduce the discount factor or discount rate, so that less discounting would happen and the growth will be seen in the numerator. Are you understanding? So that's the reason why that kind of adjustment is done. So 1.62 divided by 0.12 minus 0.08, 0.04. Now you just do the calculation.
40.5.
You will get the stock value as 40.5. Okay. So the reason for us to subtract the growth factor in the denominator is very clear. You have to reduce the discount factor so that less discounting should happen, because already in the numerator you are showing the growth factor. That means growth should be seen. If you discount with higher factor, the growth will not be seen, because the growth is, we are eliminating that growth or we are removing that growth. Okay. So if we adjust the discount factor with the growth rate, you will get a discount factor which is actual one, so that we get the value of the stock. Okay. And the growth is not disturbed in the numerator. Fine. So this is the answer, 40.50. Let's move forward. Now we are going with multi-stage growth model. Please try to understand. It's a very good question. Okay. Then you have quiz. Fine. Let's go ahead. So now let's consider a stock with dividends that are expected to grow at 15% per year for 2 years. So for 2 years, your stock is going to grow. The dividends of the stock is going to grow by 15%. Okay. What is the present value of the dividend today? $1. So now we will show that this is growing at the rate of 15% for 2 years. So we will find out, this is the D naught. D naught is 1. We will find out D1 and we'll find out D2. 2 years dividends. That means dividends at the end of first year and second year. What is it going to be? You know the formula. D naught into 1 plus G, growth factor. And here whatever you get is D1. So D1 into 1 plus G, the growth factor, will give you D2. So this is D naught 1. This is 1 plus growth factor. It is going to give you the dividend at the end of the first year. And this one again taken again with 1.15. It's going to give the dividend at the end of the second year. Okay. So 2 years dividend we got. Now we'll move to the next question. So consider a stock with dividends that are expected to grow at 15% per year for 2 years. So for 2 years, it has grown by 15%. After which they are expected to grow at 5% per year indefinitely. That means for its entire lifetime, it's going to grow at a constant growth rate of 5%, right? Considering this factor, they are asking you to find out the value of this stock with multi-stage growth model. So why it is a multi-stage growth model? Because the dividend is growing at 2 different rates. For first 2 years, 15%, and after that, constant growth of 5% for the foreseeable future, right? So this is the future value as on today for the second year. Okay. So this second year's ending value is third year's beginning value. Please tell me yes or no. D1,
Yes,
D2.
sir.
End of the year 1, beginning of the year 2, end of the year 2, beginning of the year 3, right? So why we want that? I'll explain you. So because something, okay. So what I'll do is I'll find out the stock value. I'll find out the present value of the stock as on today. What's the formula for present value of the stock? P naught is equal to D divided by what? KE minus G. Yes or no?
Yes, sir.
Yeah. So this D is nothing but the dividend of the second year we're going to take. Because second year end dividend is the third year beginning. So we are going to find out the present value of the stock as on today. So like let's say, and you know that after second year, the dividend is going to grow at the rate of 5%. Is it right or wrong?
Right, sir.
Yes. Yeah. So they have clearly mentioned, right? What they have mentioned. Consider a stock with dividends that are expected to grow at 15% per year for 2 years, after which they are expected to grow 5% per year indefinitely. Okay. And from third year, they're going to grow 5%. After that is after 2 years. Okay. So we want to find out the stock price since P naught is today's price. Okay. P1 is the price
Next year.
next year. Yeah. So allows us to use constant growth model formula with D2 to get P1. A time is equal to 1 value for all indefinite dividends expected from time period 2 onward. So the dividend at the end of the year 2 is 1.32 and the growth cost of equity is this and the growth factor is this for the from second year onwards. That means third year first day onwards it's going to grow at the rate of 5% and you got the stock value 22, right? This is the stock value at the end of year 1 because third year, first year, second year ending value, third year first value. Okay, third year beginning value. There is third year end also. So what we are going to do is we are going to take the third year beginning value, which is second year ending value, and going to find out the present value of the stock at the beginning of year 2. Second year beginning, which is nothing but first year end. Yes or no?
Yes, sir.
So first year end is nothing but you get the P1 value, right? So we got the P1 value 22. So what is the future value we took? The dividend value of the second year end. Okay, and we discounted and we got the present value of the stock at the end of the year 1. That's what. And then we have to bring it to beginning of the year. So you know, at the end of the year 1 the stock value is 22 and the dividend what is paid at the end of the year is 1.15, right?
Yes.
So these two we are going to again discount at the rate of 11% and bring the value to today's value, that is 20.86. Okay, just do this. Isha, did you understand? Please confirm.
No, I think she's not there in the meeting.
Okay. Okay.
Sir, I have a doubt.
Tell me.
Sir, in this, why are we not calculating P naught first?
Why are we not calculating?
P0, that is today's price. P1
That
is the price of the stock at the end of the first year.
yes.
Then, but don't we need P naught? Because if we do P0 into 1 plus G.
This is your P naught 20.86 which you are finding out.
Uh,
What are you finding actually? You're finding P naught only, right?
yes.
That's what.
So then directly we can do from D1 only, no? D1 by K minus G. Why did we take P1 again?
There are two growth factors. So you are considering the dividend which is growing at the rate of 5%.
Yes, sir.
Okay, here, just a second. You have considered that dividend is growing by 5%. So that you are using in the discount factor, right?
Yes, sir.
You mean to say, sir, why are we not taking this and directly going to the P naught? That is what you're saying, right?
Yes, sir. P0 is equals to D1 by KE.
You can't do because to find out the stock, first you have to find out the stock value, right? If you don't have P1, then how will you get P naught? You don't
Yes.
have P2. Do you have P2?
No, sir.
That's what. Because third year dividend is going to grow by 5% indefinitely. I understand. But we have 1.32, which is the second year ending dividend value. Third year end, why we will go to third year end?
Yes.
Yeah. So with this, we found out the first year end stock value. See, if you want to find out the third year value, the dividend value at the end of year 3, from here you have to find out perpetuity. Are you understanding?
Yes.
From first year beginning value we are finding out. First year ending value, then second year beginning value, second year ending value, third year beginning value. Second year ending value of dividend we have 1.32, but we don't have stock value. With
Yes.
this base, we are going to find out the stock value of year 1. When we get the stock value of year 1, we can find out the stock value at the end of stock value at the beginning, that is year 0. That is the beginning of the period. We don't have the third year's cash flow to find out the values, right? Do you have third year's cash flow?
No, sir.
Then that's what. And why will you find out third year's cash flow unnecessarily? Any doubt in this?
No, sir.
Hello.
Clear.
See, if you want to find out P3, how will you find out P3? You should find out D3.
Yes, sir. D3.
Yeah. So D3 would be 1.32 into 1.05 divided by 0.11 minus 0.05. But why to go to what's the growth rate? From here, we are directly taking the growth rate, right? Here itself.
Yes, sir.
We can directly do. Because we got the beginning cash flow of the year 3. That is the ending cash flow of year 2. And we can directly do, right?
Yes.
Shall we move forward?
Yes, sir.
So they are saying a key point to notice in this example is that when we applied the dividend in period 2 to constant growth model, it gave us a value for the stock in period 1. To get a value for stock today, we have to discount this value back to 1 period along with the dividend in the period 1. That was not included in the constant growth value. Okay. What they said, to get the value of stock today, that means we did not take stock value anywhere else, right? Only we took here only to get the
Yes.
present value. That's what. Here we did not take stock value. Did we take?
No, sir.
We can't take. And we don't have also there, right?
Oh, yes, sir.
That's what. We can't take. The formula does not permit us to take stock. This is just finding out the present value by discounting with some rate.
Yes.
You have to do the quiz. See, the task will increase on daily basis. You should never be lagging behind. I'm saying the course is not very tough. The course is lengthy. That's the only thing you should understand. Implied returns and cash flow additivity. So let's go for this. Rate of return for a pure discount bond. So discount bonds are what? They are always issued at discount and redeemed at par or face value. So a zero coupon bond is the best example for a discount bond. Its face value is $1,000 that will be repaid at the end of 15th year, right? From today. So you are purchasing the bond for 650. 650 bond, you are purchasing a bond for 650 today, which will be repaid to you after 15 years. From here, span is 15 years. And how much they will repay you? $1,000. That is fixed, right? They're asking you to find out the return. So there's a direct way to find out. Present value is what? 650. Future value is what? 1,000. Correct or wrong?
Correct, sir.
So present value is equal to future value by 1 plus r whole power n. Okay. And you know that is 650 is equal to 1000 divided by 1 plus r whole power 15. You can find out. Okay. But I think you can use the calculator. PV is equal to 650 minus 650 you can put. N is equal to 15. I by Y is equal to, you have to compute. Okay. Correct or wrong?
Correct.
And FV is going to be 1000. PMT is nil. Correct? Because
Correct.
it's a zero coupon bond, and you try to find out and tell me what is the I by Y return. 2.91 you're getting or not. Come on, do the calculation.
So 1.085, but that's wrong.
Just a second, just a second. I got 2.91. Why are you not getting?
1 second, sir.
I'll send a screenshot to you.
Yes, sir. I also got 2.91.
Yeah, where did you lose? Okay, fine.
I did some.
Yeah, so instead of going for lengthy methods, better to do in this way, right? Let's move
Yes.
forward. Shall we move forward? Yeah, do this question with your own skills.
So what's the name of this topic?
Just they are asking you the yield. That means they're asking you I by Y.
No, no, no.
What?
There was a subheading written before this topic, no, sir.
Fixed income.
Yes, sir.
Implied returns and cash flow additivity. I call this, these are bond related topics, right? Fixed income
Yes.
valuation. So yield of an annual coupon bond. That means they're asking like annual coupon bond is paying you, a bond is paying you annual coupon. They're asking yield.
Yes, sir.
You do this. I'm coming in a second.
Yes, sir.
Are you doing, Bhargav?
Yes, sir. So the future value is 1085, no, sir?
Yeah, yeah. No, no, no. See, consider a 10-year $1,000 par value. You should always understand that this is the only future value anytime.
Okay, sir.
Any bond, if it is either issued at discount or premium, will always be paid at par.
Okay.
Face value. Okay.
So, but if
Understood?
the current price is more than the par value, why will I buy that bond? Because when I know that uh, the principal amount I'm
No,
gonna
the
get.
bond is trading at premium. They are not saying whether you'll buy it or not. Bond is
Oh,
trading at premium.
okay.
I will explain everything to you. Don't worry. Now, if I take that, if this debate we will take up, we want 40 minutes, you know?
Yes, yes, yes.
Yeah. So
So, okay,
you
sir.
you already know like what I'm saying, standard deviation, VAR. They will use one word, but you're not aware of it, right?
Yes, sir.
So I have to make you to understand what those things mean.
Sir, it's coming error, sir, every time I put in the values.
Okay, we will see. See, N is 10 years, right?
Yes,
PMT is 100 because the bond is paying you coupon of. This is coupon paying bond, not zero coupon bond.
yes, sir.
It's paying you $100. Future value is always 1000. Present value is minus 1085 because this
Oh,
is
I was not keeping
uh,
mind, sir.
you are investing that. Then you have to
Yes, sir,
compare
I was
like that.
not keeping mind. Sir, I got it now.
Got it right?
Yes, sir.
Shall we move forward?
Yes, sir.
So there is a relationship you should understand. There is a negative relationship between yield to maturity and bond price. When the bond price, see, let's say a company has issued a bond for let's say 10% is the coupon rate. They issued the bond at, let's say the bond price is $1,000. Okay, this is the
Yes,
coupon rate, and the yield to maturity or market interest rate is also 10%. So this bond will not trade at discount, will not trade at premium. It will trade at par only. Are you understanding? Because what the company is paying and what the investors are demanding are the same.
yes,
Understood? But if the coupon rate is 10% and the YTM is, let's say 6%, then this bond will trade at what? Discount or premium?
will
Or
trade at
market interest rate is 6%. This will trade at discount or premium.
premium.
How?
So because company is offering 10.
I'll tell you. Yeah, company is paying 10% and in market people are getting 6%, right?
Yes, sir.
So bond will trade at
Premium.
premium. What price the bond will trade at? The price at which the bond should trade at should give investors their requirement of 6%, and company's payment, what company is doing should also not get distracted. So we'll fix the price in such a way that the coupon should be $100 because the bond price is $1,000, right? That
Yes,
should be equivalent to 6% yield.
yes,
So if it is let's say 1500 into 6% is no 16, you take 1700 into 6%.
1 second. 102, sir.
Yeah, so 1650 into 6%, 99. So it will trade at 1650. Are you understanding?
Yes, sir.
Because your company is paying more and the market interest rate is less, that means people are getting more than what they're expecting. The bond will always trade at premium. And
Could
the
you
pay,
explain this again how we got this price 1650?
see, again, that is a big thing. I'll explain afterwards. But as of
Okay.
now, what I'm trying to say is the price should be such that the coupon payment of $100 will always be fixed because that is the agreed payment. So
Yes.
you should adjust the bond price in such a way that it should be at the rate of 6%, giving $100. Okay. So 1656% is how much? $99.
Yes.
Almost equivalent to 100. Correct or wrong?
Yes, sir.
So the bond price will be adjusted in such a way. If the coupon is 10% and market interest rate is 12%, then what? The bond will trade at discount because your company is paying less. If you want to sell that bond, it will not be trading at higher value. It will be trading at lower value. So what will the value? Value should be such that it should be at the rate of 12%, giving $100. So how much shall we go for? It should be 800 into 12%, right? No, 830 into 12%.
So, sir, how are we
So
making it
830.
less of
How much?
830?
Discounting, right? The bond should be trading at discount.
Yes,
Not
sir.
at from $1,000, the value should go down, and the value should go down to such extent that when multiplied with 12% should give $100 only. Because this is not going to change, right?
Yes, sir.
Now did you understand what the concept I mean?
Yes, yes.
Yeah. Okay. So we will continue the next topic tomorrow. We already have discussed this, right?
Yes.
The stock price with Gordon's growth model. Did we discuss or not?
Yes, sir.
Now we did the constant growth rate, Gordon's model, right?
Yes,
Share price or value of the stock is nothing but dividend by K minus G.
Yeah.
With this, you can find out anything. You can find out G value or K value with cross multiplication. So stock value, so I'll bring it here. KE minus G is equal to D1 by V0. And KE is equal to D1 by V0 minus growth factor. So that can give you cost of equity or the required rate of return from the equity, right?
Okay. Yes, sir.
So we'll close it here. Tomorrow we'll continue with this. Tomorrow we are going to, tomorrow your chapter will be done. Okay, Bhargav? Because there are
Time value of money.
Yeah, time value of money will be done, and we'll start with the measures of central tendency. I'll see. We'll start with this. Okay. Yeah.
Yes.
Thank you. Bye bye.
Thank you, sir.
Thank you, dear. Bye.